If you ask mainstream financial analysts, economists, or even some of the more sophisticated voices in the cryptocurrency industry, what is currently wrong with Bitcoin, you're increasingly gonna hear a new word thrown around: quantum. Not inflation, not interest rates, not leverage, not ETF flows, not institutional positioning, quantum computing. The argument is fairly straightforward. Bitcoin's security ultimately depends on cryptography, and sufficiently powerful quantum computers could, in theory, use algorithms such as Shor's algorithm to break the elliptic curve cryptography that protects some Bitcoin addresses. And this isn't simply some science fiction scenario anymore. In March of 2026, Google researchers published new estimates showing that breaking the 256-bit elliptic curve cryptography used across modern blockchain systems could require fewer quantum resources than previously estimated. The paper described implementations of Shor's algorithm requiring fewer than 1,200 logical qubits in one configuration. Google subsequently announced that it is targeted in 2029 for migration to post-quantum cryptography across its own systems, arguing that the quantum era could arrive sooner than previously assumed. And suddenly, Bitcoin investors have a problem, because if quantum computers become powerful enough to derive private keys from exposed public keys, an attacker could theoretically steal coins. And if Bitcoin can't be upgraded quickly enough to protect itself, then one of the fundamental premises behind Bitcoin's value proposition, aka that your coins can be secured cryptography without relying on the central authority, comes under threat. This is no longer just some obscure concern buried in a cryptography forum. Reuters reported in July that cryptocurrency companies were beginning to prepare for the quantum threat, citing research suggesting that quantum computers capable of breaking conventional cryptography could potentially emerge as early as 2029. Reuters also reported that the potential exposure could involve a substantial portion of Bitcoin circulating supply. Bloomberg similarly described quantum computing as a threat to Bitcoin, reporting that researchers' updated estimates had intensified concerns about the possibility of Bitcoin's cryptography eventually being broken. And this is where the argument gets interesting, because Bitcoin has already experienced an enormous drawdown. The price has fallen dramatically from its October 2025 highs, and suddenly we are being told that perhaps the market isn't simply repricing Bitcoin because of ordinary macroeconomic conditions, but perhaps investors are looking several years into the future and realizing that Bitcoin could eventually be rendered technologically obsolete. At face value, this sounds completely reasonable, but there's one enormous problem with this argument. The market doesn't price possibilities in the way that people talking about them on television thinks it does. And this distinction is incredibly important, because the market doesn't simply ask, could this happen? It asks, what information do we have that changes the expected economic outcome of owning this asset? And these are two very different questions. Let's look at the central claim. The strongest version of the quantum argument goes something like this. There's some probability that sufficiently powerful quantum computers will exist in the future. There is some probability that Bitcoin will not migrate to quantum resistance cryptography in time. There is some probability that vulnerable Bitcoin will be stolen, and there is some probability that this will undermine confidence in Bitcoin. And therefore, Bitcoin should already be worth substantially less today. And this sounds mathematically sophisticated, but there's a problem. Almost everything in finance works this way. Almost every asset in existence has some probability of experiencing some catastrophic future outcome. The existence of a probability is not by itself enough to produce a massive repricing. Markets need information about the probability, the timing, the magnitude, and the mechanism of the outcome, but most importantly, they need enough certainty for investors to change what they are willing to pay. This is where people misunderstand how markets price risk. Markets don't simply price possibility. They price expected outcomes adjusted for risk and time. And Bitcoin's quantum problem is currently sitting overwhelmingly in the category of something that could happen, not something that is happening. That distinction matters enormously, because If the mere possibility of a future technological catastrophe were enough to destroy an asset's price, financial markets would be in a constant state of collapse. Think about the dot-com bubble. By the late 1990s, there were already enormous reasons to believe that the internet stocks were overvalued. Many companies had little to no revenue, many had no profits, valuations were completely detached from conventional financial metrics. Economists and analysts were warning about speculation, and yet the market didn't say, oh, there's a possibility these companies are massively overvalued, therefore let's crash them today. It kept buying. The Nasdaq rose 86% in 1999 alone and eventually peaked at 5,048 on March 10, 2000. Then, the bubble actually broke. And between that peak and October 2002, the Nasdaq lost roughly 77%. The important part isn't simply that the bubble eventually crashed. It is when it crashed. The market had years of information suggesting that something was wrong. It didn't fully reprice until the underlying assumptions supporting these valuations began to fail. And that is an incredibly important distinction. A market can know something is possible without believing that possibility is sufficiently probable, sufficiently imminent, or sufficiently economically important to justify dramatically changing the price. And we're seeing essentially the same phenomenon with artificial intelligence today. There are legitimate arguments that parts of the AI markets are overvalued. And there are concerns about the enormous capital expenditures. There are concerns about whether the revenues eventually generated by AI will justify the trillions being invested into infrastructure. There are economists and valuation experts openly discussing the possibility of an AI bubble. Aswath Damodaran, one of the world's best-known valuation academics, has also been warning that parts of the AI market have become excessively valued. But notice something. The existence of a significant probability that AI valuations could eventually collapse hasn't automatically caused the entire AI market to crash. Why? Because the market doesn't price the sentence AI might crash. It prices the expected economic outcomes of AI. If NVIDIA continues producing enormous profits, if hyperscalers continue generating returns on their investment, if AI adoption continues expanding, and if investors continue believing future cash flows will justify current valuations, the market can continue paying high prices even while simultaneously acknowledging that there is a bubble risk. And if those assumptions eventually break, the repricing can be violent. This brings us to something even more absurd. Asteroid mining. Let's picture this. Imagine that tomorrow, SpaceX, NASA, or some other company announces that it has developed a commercially viable method of extracting enormous quantities of gold from asteroids. That would theoretically create a gigantic new source of gold. And if enough gold could be brought back to Earth cheaply enough, the scarcity that contributes to gold value proposition could be dramatically reduced. In other words, asteroid mining creates a genuine theoretical threat to gold scarcity. But does gold crash every time somebody announces a new asteroid mining project? No, because the market understands the distinction between the probability exists that humanity would someday be able to mine enormous quantities of gold from outer space, and there is now an operational system capable of delivering millions of tons of gold into the terrestrial market. These are not remotely the same economic events, and this is exactly where the quantum argument falls apart. The question isn't whether quantum computers could eventually threaten Bitcoin. They could. The question is whether the information available today justifies treating the future technological possibility as though Bitcoin's cryptographic security has already failed. And the answer, at least based on the available evidence, is no. In fact, some research specifically examining Bitcoin's recent sell-off reaches exactly the opposite conclusion. NYDIG completed a report titled, "Did Quantum Computing Fears Crash Bitcoin?" And its conclusion was effectively that there was no smoking gun connecting quantum fears to the sell-off. BCA Research likewise described Bitcoin's decline as lacking a clear macroeconomic driver and noted that quantum concerns may have contributed to the sell-off, but did not explain the magnitude of the correction. Van X Matthew Siegel also included quantum computing amongst several narratives pressure on Bitcoin, but ultimately characterized the broader setup as a macro-driven bear market rather than a technology-driven failure. And this is an important distinction. Saying quantum risk exists is completely reasonable. Saying quantum risk is one of the things investors are thinking about right now is also reasonable. However, saying quantum computing is causing Bitcoin's current crash requires considerably more evidence. You would need to establish a causal relationship. You will need to show that investors are actually selling Bitcoin because of quantum risk. You will need to show that the quantum narrative explains a meaningful proportion of the marginal selling, and ideally, you would need to see the Bitcoin market react disproportionately to quantum-specific information. Otherwise, you're taking a correlation between two things, Bitcoin falling and quantum fears increasing, and turning it into a casual explanation. And we've seen this movie before. Every time Bitcoin falls significantly, a new explanation suddenly becomes the explanation. One cycle, it's regulation. Another cycle, it's China. Another cycle, it's inflation. Another cycle, it's interest rates. Another cycle, it's leverage. And now, it's quantum computing. But markets are considerably more complicated than that because Bitcoin isn't being valued by one giant spreadsheet sitting inside some Wall Street bank. It is being priced by millions of participants with different time horizons, different information, different leverage, different beliefs, and completely different reasons for owning the asset. And the marginal price is ultimately determined by what the next buyer is willing to pay versus what the next seller is willing to accept. This is why the economic models matter. For conventional assets, economists and financial analysts can model expected future cash flows, discount them back to present, incorporate risk premiums, interest rates, and probability-weighted outcomes, and arrive at some estimates of fair value. Probability absolutely matters, but timing matters. Magnitude matters, discount rate matters, alternative opportunities matter, and above all, the market's estimates of the actual outcome matters. A hypothetical event 10 years from now with an uncertain probability does not have the same economic significance as a verified event happening next month. And this is why markets can simultaneously acknowledge risks without immediately pricing an asset as though the worst-case scenario has already happened. Think about insurance. An insurance company doesn't say there's a 1% chance this building burns down, therefore the building is worthless. No, it says there's a 1% probability of a loss of this magnitude occurring over this period, and therefore we charge a premium. That reflects the expected risks, of course. It's a completely different process. Financial markets work in a similar way. They don't need a certainty that something's going to happen before considering it, but the expected economic impact has to be large enough to change the price. And this is where Bitcoin's quantum situation currently becomes much more complicated. Because there are actually several layers to the problem. First, will sufficiently powerful quantum computers exist? Second, when will they exist? Third, will they be powerful enough to attack Bitcoin-specific cryptographic vulnerabilities? Fourth, will Bitcoin have migrated to quantum-resistant cryptography by then? Fifth, how much Bitcoin is and will actually remain exposed? And finally, would an attacker actually choose to attack Bitcoin rather than the enormous numbers of banks, governments, and corporations, as well as other systems that are also dependent on public key cryptography? These are different uncertainties, and yet the market is sometimes being told that the existence of probably a few of them alone should explain a 40, 50, or 60% decline in Bitcoin. That is not how serious risk analysis work. And perhaps the most important point is this. Bitcoin is not static. The fact that Bitcoin's current cryptography could eventually become vulnerable does not mean Bitcoin's future cryptography has to remain the same. The entire purpose of a cryptographic migration is to replace vulnerable primitives before they become practically exploitable. Google itself isn't preparing for quantum computing by simply accepting that modern cryptography will die. It's migrating. And Bitcoin can, in principle, do the same thing. The real Bitcoin-specific risk isn't simply quantum computers exist. No, it's quantum computers become capable of attacking Bitcoin before Bitcoin successfully coordinates a migration to quantum-resistant cryptography. That is a much narrower proposition, and that is why the current debate is ultimately less about quantum computing itself and more about timing, governance, as well as, coordination. Yeah, there's a legitimate risk there. There's a legitimate engineering problem. There's a legitimate reason for Bitcoin developers and investors to take this seriously. But none of these things automatically make quantum computing the explanation for today's price. Because markets don't price the existence of scary headlines, they price expected economic consequences. The dot-com bubble didn't collapse because somebody discovered the internet companies might be overvalued. No. It collapsed when the assumptions supporting these valuations began breaking. The AI market isn't collapsing simply because economists acknowledge that an AI bubble could exist, and gold isn't collapsing because asteroid mining might eventually create an enormous new supply of gold. No, markets wait for information that changes the expected economic outcome. And this is why I think the claim that quantum computing is responsible for Bitcoin's current crash is one of those arguments that sound much more sophisticated than it actually is. Quantum computing is a real risk. It is not necessarily a current price catalyst, and those are two completely different things. And until we have evidence that the probability, timing, and economic consequences of a quantum attack have changed enough to materially alter the expected value of Bitcoin, treating quantum computing as a primary explanation for Bitcoin's current drawdown is less like financial analysis and more like talking, just taking a hypothetical future event and pretending the market has already experienced it. And markets just don't work that way. They price what investors believe is going to happen, not everything that could happen. And until quantum goes from this could eventually break Bitcoin to we now have a credible, imminent, and economically actionable path to breaking Bitcoin before the network can respond, there's very little reason to assume that quantum computing by itself explains Bitcoin's current price. If anything, the more interesting question isn't, will quantum kill Bitcoin? No. It is, will Bitcoin successfully upgrade before quantum computing becomes economically capable of killing it? And that is a completely different question. If you enjoyed this video, well, do well to give it a like, subscribe to the channel, and turn on post notifications so you do not miss future insightful videos.